You're hearing it in the news. Inflation is increasing credit card debt for many Americans. According to the Federal Reserve Bank of New York, credit card balances rose by $46 billion in the second quarter of 2022, a cumulative increase that represents the largest in more than 20 years. New credit card accounts rose to 233 million in the second quarter of 2022 alone, a high not seen since 2008. It's important to point out that most credit card APRs are based on the prime interest rate, which is tied to the federal funds rate. Simply put, as the Federal Reserve increases the Fed funds rate to fight inflation, that increase is increasing credit card interest rates. Credit card interest rates have already seen an increase this year from March 2022 of 16% as of September, over 18%, and just the APR on credit cards. That means that credit card debt is going to continue to be more expensive as the Federal Reserve fights inflation by raising the Fed funds rate. So as inflation increases credit card debt, what can you do about it? One solution would be a cash out refinance. If you own a home, there are loan programs out there where you can actually leverage some of the equity you have and do a cash out refinance. Now there's pros and cons. Depending on what your interest rate is on your home loan, depending on whether you have a second mortgage, a home equity line of credit, and what that interest rate is, and depending on the balance of the credit card debt and the interest rate on that credit card debt, it may make sense to do a cash out refinance and it may not. But the key here is that most Americans have seen an appreciation in their home equity. And because of that, there is equity there that potentially can be used to consolidate debt, pay off some of these high interest rate credit cards. But it doesn't always make sense. You have to talk to a lender to really kind of run through if this makes sense for you. Now, what debts can you consolidate when using a cash out refinance? You can pay off the first mortgage will have to be paid off. If you have any secondary financing, a pool loan, a home improvement loan, a home equity line of credit, a second mortgage, that could all be included into a cash out refinance. And if you have credit card debt, that can be included. If you have any type of toys, so ATVs, motorcycles, RVs, cars, all of that can be included in a cash out refinance. Doing an equity buyout, if you're going through a divorce, that can be included in a cash out refinance. So lots of different scenarios of the types of debts that can be used and paid off through a cash out refinance. So the advantage of a cash out refinance to pay off credit card debt could be to reposition what your monthly outlay is. Because when you're doing a cash out refinance, generally that loan is amortized over 30 years. So even though you're borrowing the money out of the equity, you're going to be able to pay off the credit card debt, and that payment is now amortized over a longer period of time. And remember, on a home loan, portion of that payment is going towards the principal. Whereas when you're paying a minimum payment on a credit card, if you're only paying the minimum payment, that principal is very likely not going anywhere. Home loan guidelines will vary based on the actual loan that you're applying for. And they all have a limitation on the amount that you can take when you're doing a cash out refinance. So again, very important just to have a good conversation with an experienced lender that can walk you through pros and cons, how much of your equity you can tap into. Does it make sense to limit how much you're tapping into? Sometimes interest rates on cash out refinances will be based on the amount of equity that you want. So let's say that you're maxing it out. Let's say a conventional home loan generally has an 80% loan to value maximum on a cash out refinance. Well, if you're only taking 60% loan to value, your terms could be better. So really evaluating how much cash you need to accomplish your goal of paying off the credit card debt in relation to the terms of the new home loan matters. The requirements for a cash out refinance really don't differ much than those of a purchase. So the credit score is going to be important. The credit profile is going to be important. The source of income is an important factor as it calculates the debt to income ratio. Assets or reserves, if they're needed for the home loan program, could be also important. One thing to remember though is when you're doing a cash out refinance, let's say that your debt to income ratio is just too high with the minimum payments on those credit cards. If the lender is paying off those credit cards as part of the cash out refinance, many times they will exclude those monthly payments on the credit cards as part of the debt to income ratio, which can help with qualifying. Now, using home equity to consolidate credit card debt does not reduce your total debt. Yes, your credit cards will have a lower balance or maybe no balance at all. Maybe you're paying them off in entirety, but you are also increasing your mortgage debt and likely extending the length of your home loan. When looking at this overall strategy, it is important and helpful to talk with a trusted mortgage advisor that can really walk you through what your goals are, what your minimum payments are, what your cash flow will look like after the refinance, and help you evaluate whether this makes sense for you or not. We've talked about consolidating your credit cards into your mortgage with a cash out refinance, but you may be wondering about other situations where refinance can be beneficial. Check out this video to find out more.